morning, Tim. How you doing?
Greetings and a pleasant good morning, good Monday morning to you.
Let
So
me let me make an introduction. This is Christian Fromhertz. He's the
Christian, good to
founder
meet
and
you.
CEO of Tribeca Trade Group, and he is sitting in for me. Dennis is at Disney World, if you
That's
must
what.
know. Yeah, not
Okay.
quite the Tim Quast
That's
sailing the European seas vacation. So that he's here to join us. So good morning to you, and well, the first topic that you wanted to get on is what's the probability the market rises in the year end? Well, we had a decent start to December.
we sure did. Yeah. And Christian, I know you. I don't think I've met you, but I certainly know your name. So it's good to meet you. Good to see
Yeah,
you.
same here. Well, welcome, Tim.
Thank you very much. So I'm right. Because I'm in the data business, I periodically obsess on things such as probabilities, and so this is what got me thinking about this. You two probably know who Jeff Yass is. He's the co-founder of Susquehanna International Group. So the one or two top one or two three ranked options market maker, and he's a big fan of probabilities. So he related. This is an old story, but this is his version of it. So there you I don't know if you remember the show Let's Make a Deal. There's the Wayne Brady version. There's the Monty Hall version. If you're old, like I am, and so on that show, suppose that you're presented with three doors, and I'm going to answer your question, Joel, about the
Okay.
probabilities. You're presented with three doors. Behind one of them is a Porsche Cayenne, and behind the other two are cans of Spam. And so you pick a door. Let's say you pick door number one. And before we find out whether you picked correctly, the host says, "Well, show us what's behind door number three." And it's a can of Spam. So what is the probability that you have chosen correctly with door number one? And should you stick with door number one? What do you think?
33%.
Well, so you're almost right, Joel. Most people will say, well, it's 50-50. There are two doors left, and I'm going to be right or wrong. But you are much closer. You started with a 30% chance, roughly, 1 out of 3 odds of picking the correct door. And those odds have not changed. They're still 1 out of 3. But the host is never going to show you the door with the Cayenne, right? He's only going to show you a door with a can of Spam. Therefore, your odds are 67% of choosing correctly if you shift from door 1 to door 2. You should always switch to door number 2. That's the lesson. That's a lesson on probabilities from Jeff Yass. Now, what's that got to do with whether the market closes up or down? Well, I will use math to illustrate the probability that the market rises or falls into year end. So I'm going to share my screen.
Fantastic.
Bear with me here. It's not the machine that's slow, it's me. Okay, so here's how I think about this. And Christian, we provide a platform called Market Structure Edge that is predicated on math and probabilities. It's market structure, the mechanics of the market, and it looks at supply and demand. So this stuff that looks like some kind of seismic chart is a 3-year look at the price of SPY, a proxy for the S&P 500. The green part of the graph that squiggles along between the red and green lines, that is demand, and it constantly changes. And then down below is supply, which is short volume, not short interest, but the daily trading volume coming from borrowed or manufactured stock. The market is heavily dependent on exemptions to trade through rules for market makers. And so here's where we are. This is what the market has done in the last, call it 3 weeks. And demand is way over the red line. Well, statistically, we can then go look. And of course, past performance is no guarantee of future outcomes. But every time that the market has been at an extended run above the red line, it declines. And the length of time determines the probability of a decline. And so this is not by any stretch the longest. It was actually longer in July. This period was a longer stretch above the red line than it is now. But every time there is a long stretch back to 20, all the way back, but you could take this data all the way back to when we first started looking at it in 2012, and it would be true. So the probability that the market continues to rise is 1 out of 3. There's a 30% probability based on the current math that we have a Santa Claus rally. I realize that everybody believes that we will, and we might. There's a 1 out of 3 chance that we do. But if you look at that math, that the demand in the market has peaked and declines, and it may stay up here for a little bit longer, and supply, which has had a huge deficit, a key reason for why the market has risen, if the supply continues to rise and reverts to 50%, the market will be lower at December 31 than it is now. And there is a 67% probability of that. Now, again, that's just math. We'll see.
Interesting setup for the year-end rally.
So that bottom line that you've got, that kind of is a little bit of an explanation, I guess, of why we're seeing this type of a rally too. You're saying that the supply is very low right now.
Exactly, comparatively so.
Yeah, that makes sense.
It's really interesting to go look at what happened in 2021 and when it ended. Right in here, so call it early November, you can see that supply was at 42.5, 43%. And in very short order, it rose dramatically. We rose right to January options expirations. At January options expirations, it was 44%. And a month later, it was 48%. And that was the end of the pandemic-fueled bull market. So we've had a mini version of that here. So we had a steep decline, very similar to the end of the pandemic bull market. I don't know what's going to happen. You know, what I would, because nobody really knows. To me, to get back to what happened in 2021, which was a staggering run, we would have to see the supply in the market drop at least 10% from where it is now. Now, again, what are the odds that that occurs? Well, looking back, it's very low. The probability of a 10% pullback in supply after this deficit we've had is 1 out of 10. There's a 10% chance. Look, it could happen. But I look at this and say the market is very vulnerable to something happening that surprises it. And that it's because we are near the end of a short-term run. The market has very short-term cycles, and there are reasons for it. Monthly options expirations, the way that global macroeconomic models work. Most of the money in the market today is running on models. It's not stock pickers. Stock pickers on net are sellers, not buyers. They have more outflows than inflows. So even though CNBC spends all day talking about stock fundamentals, that isn't what drives the market. All you have to do is look at the top 25 holders of any member of the S&P 500, and you will struggle to find a stock picker in them. It's all model driven. Okay, what motivates the models? Well, certainly interest rates do, economic projections do, asset allocation schemes. Are you going to be more or less exposed to equities or fixed income? That's driven in part by age. So all of those things factor in. And you could look at this market and say, well, everybody into S&P 500 rebalances, they just reconstituted. And those rebalances will occur at December options expirations, a quad which is going to be overweight equities, maybe bonds too. My portfolio, which is more skewed because of my age to the managed accounts, not the trading accounts, to bonds, the bonds have crushed it. Bonds have outperformed equities here lately. And are we overweight both? Yes. I've been talking to my advisor saying, maybe we are overweight both elements. Are other people doing that? Well, yeah, I think so. Probably.
So is it still possible, though? I mean, what circumstances?
Sure.
I mean, where's that supply going to come from? Is it the Fed cut? Is that it? Is it everyone knows that rates are going to be cut in March, and we just got to pour money into the market? Because I kind of feel the same way. Maybe we had our end of the year rally in November.
Early, right? Well, mathematically, I don't know what factor might affect it. I can say mathematically what has to occur, and this, traders, is what you look for, because look, you check the data. I check the data every day on the supply and demand side. If supply continues to rise, the run's over. If it reverses course, that's what would have to happen. There's not a high probability of that, but it's not out of the question. And what causes the supply to change? Well, you have to think about, again, the mechanics of the market. You would suppose that for every buyer, there has to be a seller. Well, then how would the market continue to rise if no one is selling equity positions? BlackRock, Vanguard, and State Street alone own, call it, 35% of the market. So if BlackRock, Vanguard, and State Street aren't selling, how can the market continue to rise? Well, there's an answer to that. The answer is the derivative components: futures, index futures, options, stock, ETF, and index options, and ETFs themselves, which are very elastic. ETFs are created to absorb demand. There is almost never a reduction in the number of shares of ETFs outstanding. And ETFs are created at a rate of over $500 billion a month. So those things then increase the capacity of the market to absorb more money, but it's also sort of inflationary. If those things continue to happen, Joel, we will have a Santa Claus rally.
All right, so
Statistically, and say it's difficult.
you want to go to some individual stocks and talk about how you're going to decide to trade them long or shorts, or anything popping up in the BZ portfolio as the S&Ps continue to leak here? Go ahead, Tim.
Yeah. Well, I always look, if there is momentum in the market, there will be momentum components in the momentum portfolio. The momentum portfolio looks for steep supply-demand divergences, and there are 9 in it. That's not a lot, believe it or not. In the Benzinga, these are the ones that stand out to me that have been very effective, and it's been true since the last time I was on, which was back before, I think it was back in mid-November. And so Square was in that portfolio at the time. Natera was in it. Look, I'm not speaking to the quality of these businesses. I'm talking solely about the probability of producing returns. And interestingly, if you single out Square, which I have traded, if there's momentum opportunity, I look for a reasonable gain. What is the probability of a 2% gain or more in 1 to 5 days? That's how I think about it from a short-term trading perspective. That differs from long-term investment. Well, in Square, looking back over the trailing year to date, believe it or not, when it is at 10 and supply falls, this has happened 9 times in Square in 2023. It has risen more than 2% every single time, 100% of the time. Natera is closer to 83%. Affirm around 82%. Coin 89% of the time. So those are very high probabilities of returns, all other things being equal. It depends heavily on broad market sentiment. Is money continuing to come in? Well, the market's at 6.4. It's over the red line, but it means that probably I can make 2% in any of those in 1 to 5 days. And those are high probabilities. That's what it's all about.
Okay. Tim Quast setting things up for us, as he always does on Monday. Tim Quast, CEO Market Structure Edge, joining us here on Pre-Market Prep. Doing a great job as always, Tim. We'll dial you up again real soon. Looking forward to following your thesis through the end of the year.
Have a good week, gentlemen. Christian, nice to see you. Joel, thanks for hosting.
Yeah,